Today's episode is all about what happens when a great company says we'd like infinite growth, and then reality says great, but electricity still comes with a cost.
OpenAI may be the hottest company in tech right now, but even hot companies eventually need to meet the unsexy chaperone, capital discipline.
And that's where our handy spreadsheet enters the chat.
All right,
Okay,
we are
Jamie.
back, Cindy. Second
Yay, we're
time on
back.
OpenAI, right? So we talked about it
It's,
last time. We talked about kind of the operating business.
yes. We talked about just how they work, what it takes to run their company. And so now we want to talk about another part of that article, which is all about the IPO that they're considering. So, what is OpenAI doing and why is everyone talking about it? Okay, Jamie. So, the article that we've been talking about and OpenAI, we talked about the basics of how OpenAI's AI works and how it incurs a lot of costs. But the other part of that article talks about the IPO. So before we actually go into what OpenAI is doing to get ready for the IPO, can you just level set us on what an IPO is?
Oh, sure. Yeah. So IPO stands for initial public offering. And what it is it's the transition from a company goes through to go from a private company to a public company. And it is typically what is called the last round of raise. So, what has been going on right now at OpenAI is they have gone through several rounds of private money trying to raise the money so that they can spend and build the infrastructure that they need. The last step then is to say, I'm going to do one final round of raise. And at the same time, allow everybody who's been giving me money at this point the opportunity to cash out. Okay. And that is an IPO. It's a complicated, long structure business, right? But what it does is it changes you from a private company that has very limited amount of disclosure requirements, a lot of secretive items, and every valuation you see is based off of guesses and estimates to a very
Mhm.
public forum where there is actual trading happening on your stock day in and day out. It's very liquid and every eye is upon you.
Yeah, so it's definitely a trade-off, right? Not having to spill all your secrets, but and staying private versus raising that extra cash. But I think there was a report I saw recently that said that there are many, many fewer companies going public. And I know I don't see IPOs in the headlines all the time anymore. So are fewer companies choosing IPOs today?
Yeah, that's absolutely true. But it's a little bit because of how the market has evolved. So it historically used to be that a lot of very tiny companies would go public. You would see
Mhm.
micro cap, small cap companies go public at a fairly decent rate. That has dropped off about 50% since the 1990s. So there's about 8,000 companies back then. Now there's about 4,000 companies doing this right now. And here's why. We have the rise of private equity. We have the rise of venture capital, angel investors. You hear all of these
Mhm.
terminologies, but what they are private methods of raising significant capital. It's no longer just a bank loan. Oh, I've gotten too big to go to a bank. I need to go public. Now there is significant infrastructure around staying private
Mhm.
and still being able to get money, which is why we're seeing this kind of slower rate. And as a result, when you are trying to go from private to public, you are also typically much bigger than you used to be in order to kind
Interesting.
of cash out.
And that is reflects what I've been seeing in the headlines too, because we're not seeing so many early companies go public. When you feel like you're investing in the underdog. Like I used to feel like it was that way. So basically, what you're saying is we're delaying the shift of accountability. Is that right?
You're right. Okay, so understand if you're filing with the SEC, which is what you have to do in order to be a publicly traded company, that means every quarter you are issuing income statements and balance sheets. You're having conference calls that are public that everybody can see. So you are getting a regular check-in on your fiscal responsibilities. If you are a private company, on the other hand, you only have to tell investors as often as you told them you would. So I may make a
Mhm.
deal in a private market that then tells me I'm going to get a report annually or semi-annually. I may not get numbers very well. I may not have a CPA firm coming in every 4 months trying to check what I'm doing, or 3 months every check what I'm doing. I don't have to provide fully blown audited financial statements, although most do at that point,
Mhm.
the way that you would with the SEC. And so, with everybody's eyes on it, literally millions of people's eyes on it, compared to a select few that you're having in the private market, it means that your accountability just went through the roof.
I don't have a problem with the level of accountability for publicly traded companies. I think it's to protect us, the public, and to make sure that they're
Oh,
being transparent. So I just,
topic for the
I know.
future, Cindy.
Okay.
Topic for the future,
All right.
because
All right.
there is, so we will have to get into this someday, because there is still something in the background. Trump suggested no more quarterly reports for the SEC.
Oh, yes.
So
We talked
we,
about that. Okay.
yeah, yeah. So
Yes.
that we'll
Okay.
probably need
Well,
to circle back at some point, but that's not what we're talking about today.
no, we're talking about OpenAI right now. So, how is this shift to public affecting OpenAI today?
So, OpenAI is actively grooming for the public market scrutiny. They've hired Cynthia Gaylor, the former CFO of DocuSign, as their first head of investor relations. And that's a very specific signal. They're sitting there actually recognizing and building the infrastructure to talk to the public. They're shaping their governance, they're expanding their disclosures, and their internal targets report that they're trying to file potentially in the second half of 2026 with a 2027 IPO potentially there, valued at $1 trillion.
Okay, that is an insane amount of money. And I must also just say, just from a leadership perspective, that's kind of a healthy forcing function, if you will, because most organizations end up with a lot of groupthink, and they really could use someone else looking over their shoulder, asking them really hard questions that they may not have asked themselves. So I see this as a really good thing from an organizational health perspective.
You're absolutely right. Public investors are going to ask things that private investors will often let slide. They don't necessarily need to know what is going on. They have a lot more trust in the management. I got to tell you, I used to be a public investor, still kind of am in the small markets,
Mhm.
and I, as a result, have a reputation of being blunt, sometimes even rude, because in the public market, you sitting there and quizzing a CEO left and right about what their decisions are doing is not considered rude. It's considered due diligence, right? So
Right.
OpenAI is currently valued at a massive 65 times its 2025 revenue, right? That's an extraordinary multiple. We don't see a price to sales of 65 times. You just don't see it in the public markets. And so the public
Mhm.
markets are going to require a lot more production very quickly.
Absolutely, absolutely. So if we look at how this is showing up, what types of questions are the investors asking, and specifically, like, um, are they questioning their overall strategy, or are they just questioning the execution of their strategy?
Both. Everything is on the table, right? Are your margins durable? How durable are they? How much growth is being is going to occur? Or is that being subsidized by your infrastructure spending? What are your long-term purchase obligations? What do the software economics look like? There's so many
Mm,
questions that everybody is going to ask this company. And we've got some pretty tough answers that are going to happen, right? So the reporting around the Texas Abilene data center really reinforces
yeah.
the idea that not every grand infrastructure plan survives contact with financing, right? So that's what we talked about last time.
So they're making those tough decisions of, hey, maybe owning our own data centers, or at least our date launching a $650 billion, if I remember correctly, we're launching this global infrastructure on the backs of the private equity and or the public, let's say, because they want to go public. It's probably not the best decision. We should pull back on that. They're going to find a different way to do their compute. More is not always better, but maybe being more disciplined is better. And I think we saw that as well when they canceled their Sora application, which I think Disney had promised $1 billion investment in their licensing their characters to Sora so that people could make apps. But I'm going to just say this is not a firmly validated number. But I read that they were spending 1,500, or excuse me, $15 million a day just on the compute behind Sora for very, very little, like minuscule revenue. So it sounds to me like they are making some of those strategic decisions. But if we just look at it at an overall, how fast they're burning cash, what does that look like?
Yeah. So last time we talked a lot about the Stargate infrastructure system, right? Which is
Hmm.
where they have been burning a lot of their cash. So when we go public, right, the
Hmm.
market is really your last step. You've been raising money time after time after time in the private market so that you can grow. When you become public, the idea is that this will be one of your last, if not your last round of significant funding in the short term. Okay, so what will happen is a company, let's say, like right now, OpenAI, if you look at their last round of funding, which closed on March 31st, they raised
Hmm.
$122 billion in that round. Okay. They're going to take that 122 billion plus everything else they raised in their other 11 rounds of funding. They've done 12 rounds of funding in the past like 4 years, right? So these 12 rounds of funding, they've been spending that cash down over time. And we're talking that they're going to burn $17 billion of cash in 2026. And their projected number is $190 billion of cash burned by 2030. If you're running through that cash, when you go public, you're already worth potentially $852 billion. That's what all of those raises and how much the
Hmm.
multiples were on those raises suggest and imply that OpenAI is worth right now. They're going to IPO and want to do another raise during that process. So here's what's going to happen. They sit there and they say, I'm already worth 852 billion. I'm going to
Hmm.
need another, say, let's go with, oh, let's do the top end range, right? So Alibaba, Aramco, these guys raised about $30 billion, 20 to $30 billion
Okay.
in their IPO. So we're going to go with that rate. So let's say they decide, you know what? I'm OpenAI. I'm going to go even higher. $40 billion. I need 40 billion more dollars, but it's the last one, right? So I'm at 852 billion right now. I assume I'm going to grow over the next year, and I'm going to need an additional $40 billion of new cash coming in. Okay. If
Okay.
I IPO at $1 trillion, okay, which has happened one time, single time, Aramco, and that's really Saudi Arabia. It's a government owned thing. There's
Hmm.
some real questionable things associated with it, but it has happened one other time. $1 trillion market cap comes out. Then what will actually happen is this: 40 billion of it is new cash from new investors who have actually bought in during the IPO. Okay. The
Hmm.
other $960 billion is already in existence today from their prior raises. And that's the money that individuals like, private equity firms and the Microsofts and the Amazons who own shares in the private open AI can now go to the public markets and cash out those ownership shares and get their gains, get their money back. Okay. When we sit there and we talk about IPOs and we're saying $1 trillion IPO, that's not new money coming in. That's $40 billion coming in out of $1
Hmm.
trillion.
So when OpenAI goes public, they're not creating new shares. They're actually converting the private equity shares to public shares. Is that right? Or are they creating a tiny bit of new shares?
960 billion of existing private shares becoming public,
Mm.
$40 billion of new
There you
shares,
go.
in
Okay, I
my
get it
opinion.
now.
Right. So,
Wow.
yeah.
Wow.
So that is what we're talking about when you're doing an IPO. And that happens every single time an IPO happens,
Right.
by the way. That is how that system works. The numbers are extreme in this case, right? But that is how an IPO works. The problem is for OpenAI is not only the accountability that we've been talking about and we're going to have to continue to talk about, it's the idea that it's probably your last raise that's going to happen or
Yeah.
need to be one of your last raise because they can't come to the market and get $40 billion next year in the IPO and then turn around and say, oh, hey, guess what, guys? We've burned through all that cash. We need another $50 billion
Right.
the year after and then the year after. That's what the private markets do. That is not what the public markets do. It's
Right.
incredibly expensive to raise money on the public market, which is why most companies It's a one and done. Secondary offerings are not terribly common. And when they do happen, they're in very specific little niches. You don't see large scale ones like what OpenAI made to do if they continue that cash burn rate.
Got it. We talked about there being expectation and regulation so that it's very transparent to protect the public. But the public then also has an expectation that they're going to get a return on the money. Everybody expects that they're going to get a return on the money. And I think something, and maybe this is just me, but I think people forget that when you buy a stock, you're loaning the company your money to use and you expect interest on like you expect a return. I think people forget that we're not just giving you the money. No, this is not just you can have fun. No, this we expect a return. So the risk in the private markets is higher for sure, right? If you invest in a private, the risk is higher and the return will probably be higher. But there's also risk in the public markets. Stocks are considered risky. So, but it might be a little less risk, but we still expect a return. So I think that's that scrutiny is not for nothing.
No, you're exactly right. So we're going to start looking at this company and they're going to have to start answering some really hard questions. Please understand, private equity people are also asking really
Yes,
hard questions, but they're asking
agreed.
it behind closed doors, which is a
Right.
much different idea. You can give grace, you can give time, you can say, okay, let's improve on this. Whereas doing it in a public system in front of a microphone is much, much more difficult. And
But
you're not
let me
going to
ask
get
you,
the time and grace that you would maybe get in the private market.
but a private equity firm has an expected time in which they're going to recoup their money. You were
Yes.
explaining this to me that like maybe a total 10-year span. And
Mhm.
so I need the last 2 or 3 years to get you public so that I can get my return. We've talked about this consistently. I don't know that the private equity companies are asking the long-term viability questions needed behind closed doors to ensure that
No,
saying
they don't care.
like they just care that it gets to IPO plus 1 year.
Yes,
Like
because that's when
we
their
care.
lockup period ends, right? Their
Exactly.
IPO plus 1 year, they get their lockup period down because they don't want to flood that $1 trillion all on the same day, right? So when they actually do go public, they raise the $40 billion. There will be a small slice that can also cash out at that point.
Right.
But for the most part, they're going to have these kind of cliff hangings of, okay, now the next group can come, now the next group can come,
Right.
and they'll so that they can sell off in an orderly manner within the markets, and so that they don't crush the stock price. There's a lot of nuances that we're just blending
Skipping
over
over.
right.
So the problem that OpenAI has is not demand. OpenAI has a lot of customers, right? That's not
They
what we're
do.
talking about.
Yeah, we have tons of consumer-based customers, right? And that is gone really well for them. But what has it actually generated? It's generated growth, and Wall Street loves growth.
I think consumers in general are stingy. We do not like to open our wallets just because it's very, very difficult for us to calculate an ROI. We just see cash going out, but businesses are more likely to spend. So I think there is some interest in shifting. But OpenAI has tons of customers. They have the most customers because they were the first to go to be publicly facing or to sort of get some mainstream media attention. And so they have a ton of customers. So, but the problem isn't that then what is the problem?
The problem is that AI demands unusually expensive compute to serve its public, right? So the
Mm.
cost reportedly rose fourfold in 2025. Adjusted gross margins dropped from 40% down to 33%. Instead of scaling and seeing operational leverage, this company is seeing what we call diseconomies of scale. That's what it would be called, right? In
Right.
economics, right? A
Interesting.
significant warning sign.
Yeah. We talked a little bit last time about how the AI technology works. And these companies invest huge amounts of money to train their models. And it's not just one chip, they cluster, they get all these computers together, working together to shove data through them simultaneously. And so they have that problem, but they also have the problem that every time one of their chat GPT users actually uses it, there's yet another bill associated with it. I'm sure they're able to get some of those prices down, but there's a cost associated with all of these things.
Yeah, in most software businesses, scale is your friend, right? You scale it up, same amount of set fixed costs, and you get to diversify it over over more and more people. However, the problem is that OpenAI has variable costs, and that variable cost is just exploding. So right now, higher usage means higher variable costs, unless they can
Mm.
figure out a way to crack down on efficiency or product mix.
Okay, so just because we have a lot of people that want our product doesn't necessarily mean that the finance team is happy. Like that's what I'm hearing you
Correct, correct.
say.
Yeah. Revenue applause can hide margin panic.
I love that. So I think there is a lesson for managers here that just because demand is strong and it feels like the business is healthy, they're not the same thing. So strong demand is fantastic, but if there's a disproportionate cost to serve, we need to know that before we run out of money. And I think that's what a lot of this inspection looks like and is
Yeah,
about.
and we're going to see some big changes, I think, as a result, right? So for everyday consumers, there's going to be pricing changes,
Mm.
premium tiers, paywalls are not a bug. They're a feature. They're actually the business model
Yeah.
trying to catch up with the physics of how to make money.
And
Yeah.
I think we may see advertising, right? I know that we were talking, there was some mocking at the Super Bowl over
Oh
ChatGPT
my
doing
goodness,
advertising.
Claude did such a good job on those creepy
Yeah.
ads.
Yeah, which I've got to see, by the way. I have not seen any of them. I've just read about them, but I think we can expect to see advertisements, and especially in a consumer facing product, because remember, we don't want to pay money. We want of our wallets. So I think that's a change that we can expect as well. Okay, Jamie. So you're telling me that we're basically saying that for every new customer, OpenAI situation is actually getting worse.
It really is in some ways, right? Because of the demand for the compute, how much they expect it to grow, all that infrastructure that is going into there. And as a result, that cash burn that is killing them right now. They're obviously starting to change. We've already talked about advertising. I suspect we're going to start seeing it become more expensive for consumers as well, because just advertising alone is not going to
Mhm.
overcome that cash burn. So they actually need to do this, right? But I want to
Mhm.
talk a really quick sec and warn the everyday investing public if they go ahead and do this IPO. What is going to happen when they raise that $40 billion and they become a $1 trillion company in the stock market? Normally, you'd say, well, that's okay. I just won't invest in them. But my guess is that you're probably one of the 50% or more of
Mhm.
people who invest in the S&P 500 index or the Russell 2000 index. You index your money because you've been told passive investing is much cheaper than active investing and has a better return. All of those statistics are correct. But what it means is that OpenAI and all of those private equity firms, so that $852 billion of existing supposed value under OpenAI, will start cashing out on the back of indexers. If you come in and you're a $1 trillion company, that means that it's going to be, say, 3-4% of the S&P 500. And so all of those multiple trillions of dollars that are invested in the S&P 500 indexes, again, remember, more than 50% of the market money is invested in indexing, will then have to go ahead and buy a 3% stake in
Mm.
OpenAI to maintain their index level. That's going to generate a huge amount of liquidity and actually probably force up the price, at least initially, on the indexing demand. Okay, that means the
Interesting.
market goes up and it's like a self-feeding item. It gets bigger, which means as an index, I need to own more. It becomes this really problematic thing. What it will then eventually do as we all buy our index stake is then the demand can dry up because we're starting to look at the fundamentals of the business
Mm.
significantly more. And so what may happen, and this is what my personal worry is that OpenAI goes public. All of the private equity funds who have been doing this end up cashing out on the back of our everyday indexers, the people who have that in their 401k, who have no choice about whether or not they're going to own OpenAI or not, because it's just a part of the
Mm.
index. And then the people who will take the loss when it turns out they can't live up to the hype, they're still burning cash, they need a second round, won't be these private equity individuals. It will be the everyday Americans who are invested in their 401k in the index. So this is kind of a tragedy
Yeah.
potential that could happen. Now, I don't want to be doom and gloom, right?
No,
OpenAI is trying and is working towards being more accountable and adjusting their business model so that the fundamentals look better, right? But
right.
that gives the managers a lot of lessons that they need to learn.
Absolutely. Yeah. And this is managers everywhere. Know where your costs are and know them really, really well. Because if you are scaling up on something that's very, very expensive, that has a very, very short runway. That is not a good strategy that you're setting yourself up. So you need to understand where your costs are. And that means if you are a consumer of AI, right? You're a manager who's a consumer of AI, that it's not free. It's not free. So just remember that.
There is no free lunch.
Exactly. And I think this hype thing, how do you see managers normally handling like a market hype like this?
You have to
Right.
reward confidence and restraint, right? So how
Mm.
these individuals are going to get compensated in the long run. Put those stock options that I was just talking about at a 5 or 10 year vesting period, not a 1 or 2 year vesting period, because
I
we
like
need
that.
long run return
I
on AI.
agree. And Jamie, I talk to my students about this all the time. Optionality, building an optionality into a business, but optionality does not mean being all things to all people. It means that in the critical components of your business, like supply chain, for example, that you can choose different suppliers where at all possible. That you have vendor diversity. That you can switch vendors, which literally I'm finding challenges in my own life right now because I'm using one AI provider to do a lot of work for me. And now I want to try this other one and I have to redo my code. Like, so optionality is a good thing. But it doesn't necessarily mean the lesson that I'm taking from this OpenAI thing is trying to be all things to all people.
Exactly. Yeah. And honestly, you need to tell the truth, right? What's going on in AI right now, what's going on in OpenAI, you have to tell your team things are going to change. We have to change for our next phase of evolution, right? Right now, there's
Mhm.
so much money flooded into AI. And this is a problem at NVIDIA. This is a problem at OpenAI. It's a problem pretty much everywhere. When you hear pulling back, you may think that there's something going wrong. In reality, it's not that
Mhm.
it's going wrong, it's that the management is growing up a little bit and being
Discipline,
responsible with what they're doing now.
which is a really good thing always.
Yeah.
So I think the key takeaway in OpenAI still may be the future, and they may be in everyone's portfolio here before too long. But even the future had to pass the budget test.
That's absolutely right. It's an interesting story, and every leader who ever believed in scale would think that it magically organizes itself, but the reality is the world is messy.
So you want to take us out of here, Jamie?
Sure. And that may be the most important business lesson of all. Visionary companies still need adult supervisions. I think we got more to unpack. We're probably going to end up having to have a third podcast on OpenAI, but let's go ahead and say until now, keep your spreadsheets handy and your coffee strong.